Hey guys, and welcome back to the Young Investors Podcast. We're at episode 48, and joining me as always is Brandon. How's it going, Brandon?
Yeah, it's going well. How have you been? What you been up to in the last week? Oh, how did your fishing trip go?
Oh yes, it was good. Successful. Well, I mean, moderately successful. We caught a lot of smaller flatheads, but nothing good. So it was better than last time where we caught nothing and the weather was terrible. The weather was really good.
You didn't get a new profile picture in the process though, where you're holding this meter long fish or something?
Exactly. I didn't get dragged down by a 50-kilo tuna or something. No.
Giant tuna.
Unfortunately not.
You know, when I was younger, I always thought tuna were just these tiny little fishes. And then it wasn't actually until recently that I realized just how big tuna fish actually are. They're enormous. They're huge.
Yeah.
Again, starting with a bit of irrelevance, but that's all good. Oh, I'm glad your fishing trip went well. It's better. It sounds like you had a better time than last time.
Yeah, no, it was good. But in today's podcast, we are going to talk about some investing stuff this week.
Yep.
We're not going to just ramble on about random stuff, but we'll go through our indices, which we're doing this podcast again on a Thursday. So these indices will be from Thursday to Thursday instead of the whole week.
Oh, okay.
We've got a couple of news stories that'll be interesting to talk about. And then in our major section, we're going to talk about the difference between investing in large companies and small companies. So there's many different sizes of companies, and does it matter? What is the difference?
What's the schools of thought?
Yeah, what are the kind of differences that we see? What are the different risks and
all that sort of stuff?
Dividends, stability, all that kind of stuff. Yeah. And then towards the end, we've got a couple of Q&A questions. And as always, if you have a Q&A question, you have a question that you want us to answer next week, then make sure you go ahead and leave it below the YouTube version of the podcast, which is on my channel this week, youtube.com/Hamish Hodder.
All right, cool. Get into the indices.
Let's do it.
Yep. So from Thursday to Thursday, right?
Correct.
Yeah. Okay. So the Dow was down 0.2%, S&P down 0.1%, the Nasdaq was down 0.1% as well, and then the ASX 200 up 1.3%, and the All Ordinaries also up 1.2%. Not quite as much, but yeah. Interesting. Not too much happening in the States. I haven't seen how the chart looked in between those two dates. Has it bounced around much, or hasn't really done too much? I'm not sure.
Well, in terms of the Australian market, almost all of that 1.3%, 1.2% came last night. Yesterday.
Really?
Which is on the back of some news out of the US, which is interesting. The Federal Reserve actually cut their rates for the second time this year. So they cut their fund rate they cut it by 0.25%, and their new range is now 1.75% to 2%. That's the range.
Okay.
But this was expected, so it didn't do too much for the US market.
Right.
In terms of the Australian market, it made the Australian dollar a little bit stronger against the US dollar, naturally, as that kind of always happens when there's a change in the interest rates. Interest rates go down in the US. It means that their savings accounts and their term deposits can't offer as good a return as they did before, so it makes the Australian dollar a little bit stronger against the US dollar.
Yeah, it's interesting. So they're lowering their rates, so it means that borrowing money is getting easier. So again, they're trying to help, I guess, stimulate their economy a little bit. Is that right?
Yeah, they're trying to get a little bit more stimulus. Trump had some nasty tweets to say about this, which was interesting because I swear he was trying to get them to cut rates for a while there. But now he wasn't happy about this one. But I don't know.
Okay.
Apparently this was fairly expected. But I just read some comments from some analysts, and they believe that the reason why the US market went down on this news is because they're not expecting there to be any more rate cuts this year. So there's going to be no more stimulus is what the market's expecting, and as a result they went down, which is kind of scary because when the market goes down on good news, like this is good news for stocks.
Yeah, it is.
It kind of makes you wonder what's going to happen next if they're going down on good news.
Yeah, it's kind of those I guess it's one of those pickles, like when you do something. Another example might be when you do something like this to stimulate the economy, and then the economy just doesn't start growing again. It's just like, oh, okay.
It's going to be interesting. One thing that I thought was kind of interesting out of this was that the vote by the Fed on the rate cut was 7 votes to 3, so it wasn't unanimous.
Yeah, right.
So there's a bit of a mixed opinion on the Fed at the moment, which we don't really worry too much about these kinds of things. We try not get ourselves caught up in the broader market forces, just focusing on the individual businesses and what they're doing. I guess what the Fed does in the future might create some opportunities in individual businesses, but aside from that, it's not really that important, I guess.
Oh, I hope it does. I really hope it does. It's getting to the point at where it's a little bit frustrating at how how little deals, how few deals we're being able to find in the markets, but maybe soon enough. Who knows? We'll just have to wait. That's the thing. We got to stay patient. Have to stay patient. All right. What else have we got in news?
Yeah. So another news story we had here was that earlier in the week, oil prices saw their biggest spike in 10 years. Their biggest one-day spike. So earlier in the week, there was an attack on a Saudi Arabia oil production facility.
Right.
And this was one of their biggest production facilities.
Okay.
And it actually disrupted half of their entire oil supply.
Whoa.
So, and just to put that in perspective, that's 5% of the world's daily oil supply was disrupted by these attacks. And essentially oil prices rose as much as 18% on the news on that day, which was the biggest one-day gain for oil in over a decade.
Whoa, jeez, that's crazy. Do you know how it was attacked? Was it like blown up, or was it just like, did it sustain damage, or?
Yes, so I don't know a whole lot about it. There's a lot of speculation about who did the attacks. There's some terrorist groups that are claiming responsibility. Trump's obviously blaming certain people on Twitter. He's always got his own opinion. But yeah, they were like explosive attacks, and I mean it took out half of their entire oil supply. Right. Which was it's not good.
So it's been attacked as in it's been physically destroyed.
I believe so, yes.
Right, okay. Man, that's crazy. I haven't seen anything about this story. Man, I must have been living under a rock or something for a while, because I have not seen anything about this. That's crazy. For 5%, like 5%, yeah, it's not a big number, but like in terms of when you're talking about global supply of something, 5% is a huge stat. That's a lot of oil. But wow. Man, I'm surprised I didn't hear absolutely anything about this. Is that all we've got to talk about for this news story?
Yeah, that's all for that one. And the last news story I just wanted to sort of chuck in came out of FedEx. So FedEx reported their first quarter 2020 results. And this is a company that I've been following a little bit, not a whole lot, but it was interesting because of how dramatic the stock price movement was after it. But essentially, their revenue numbers came in at $17.05 billion, which represented 0% growth from the same quarter last year. So it was flat year over year. In terms of their earnings per share, that came in at, this is adjusted earnings per share, it came in at $3.05, which was down 12% year over year.
Right, okay.
And essentially management, for the most part, management seemed to be blaming weakening global economic conditions. It's kind of something that FedEx's management has been saying for quite a few quarters now. They also blamed the fact that they lost Amazon as a primary customer, although Amazon was only contributing about 1% to their total revenue. But yeah, on the news, interestingly enough, the stock was down 13% today,
big hit.
Last night. So yeah, investors weren't happy. And I listened to some commentary on this, and a lot of people seem to believe that management are avoiding talking about what's really happening. And investors are getting frustrated by that because it's been a few quarters now where they've kind of just come out and said, weakening global economic conditions, out of our control, this isn't our fault kind of thing. And investors are kind of looking for something a little bit more tangible. To kind of figure out what's going on. But then again, I mean, that might just be the truth. I mean, this trade war is ongoing that obviously has a massive impact on FedEx's business. But yeah, I mean, I don't know much more to say.
Yeah, one thing that I always like to, this might be a good company, say, to go and listen to the conference call of, to see what the management's saying. But one thing that I like to see on the conference calls is a CEO never blaming anything else or anyone else or any other company for the failings of their own company. I just think that it's almost just like a really good life lesson. If anything bad ever happens, just assume that it's somehow your fault, and just think about the ways that you could have changed the situation, and try not to blame other people. Try and look to yourself and say, well, the only thing I control is what I do, so I better do something about it if I don't want it to happen again. So I find that interesting, and I hear, for instance, like, I always draw the example to Tesla, but when I listen to the Tesla conference calls, Elon's never interested in blaming other people or other factors or anything like that. He always tries to take responsibility for the shortcomings of the company or whatever like that. So it could be a really interesting one to listen to, because it sounds like maybe management are just trying to, sweep the problems kind of under the carpet and not really worry about it too much.
Yeah, it'll be certainly interesting to follow them over the next few quarters.
So I guess what they're saying is, so they're blaming it mainly on weak economic conditions. So they're basically saying that because economic conditions are getting worse or maybe not growing, people are buying less and they're delivering less stuff.
Yeah, and the trade war kind of plays into this because there's a lot less movement of trade between China and the United States as a result of the trade war. And FedEx's business is one of the businesses that is so closely tied to economic activity, because if there's an increase in economic activity, there's going to be an increased demand for parcel services. Like, it's kind of directly tied between business growth and FedEx's growth. So if businesses are selling less products, then FedEx is going to be shipping less of those products. So, it'll be certainly interesting to follow. But it's not a company that I take a whole lot of interest in. I've looked at it in the past, but that's pretty much all I have for those news stories there.
Right. Okay. So with all that wrapped up, we'll get into the middle section of the podcast, I guess, and we're going to be talking about in the middle section of the podcast, like what Hamish was saying up top of the podcast. We're going to talk kind of compare and contrast large companies versus small companies, because there's lots of different kind of schools of thought when it comes to investing. You should definitely avoid small companies, never invest in them. And there are other people that say, why are you bothering investing in large companies? They're so big, they're not going to grow heaps into the future. So I guess what I wanted to talk to you about today in the podcast is just not necessarily what one's better, investing in large companies or small companies, because I think we both agree that you can find fantastic investment opportunities in big companies or small companies. But I guess what I was hoping to do is kind of just have a bit of a discussion around the differences from an investor's standpoint. What are some of the differences that you might see in your investing journey through, say, buying shares in a large company or buying shares in a small company? Does that kind of make sense?
Yeah, definitely. And like you said, there's always opportunities in all of these, but it's also important to look at the broader trends, so that, when we're doing individual analysis, we need to hone in and look at a certain subset of businesses. So deciding whether you're going to look at large cap businesses or medium businesses or really small businesses is something you kind of have to do at a top level. And it means that we need to look at the broader trends of what is happening in larger companies compared to medium companies compared to smaller companies. Yeah, and in saying that, when you're doing your individual stock analysis, a big part of that is also looking specifically at the industry that the business you're interested in falls into. And in an industry, no doubt you'll have large cap companies, medium-sized companies, and very small companies as well. So it's also important in that aspect to get a better understanding of how the industry itself works, who are the major players, who are the up-and-comers, who are the ones that kind of sit in the middle, that kind of thing. Yeah, definitely. Did you want to start us off by sort of giving us a bit of a definition of how we're separating out these companies before we give us a bit of a definition before we jump into talking about some of the differences? Yeah, I'm certainly not an expert, and I don't know if there's a globally or a globally recognized classification system of what makes a large company or a medium company and so on. But I guess for me personally,
a large company, and we're talking about market capitalization here. So market cap, I would say a large company would be kind of anything from $2 billion onwards, market cap of 2 billion onwards, probably up maybe more in the 5 billion to 10 billion range. Especially with now today, we've got companies that are worth literally $1 trillion. It's like you rewind the clock 10 years and that number just seems ridiculous, but here we are. So I actually almost think that these days maybe a $2 billion market cap isn't quite such a massive company after all. But anyway, I'd kind of say that then a medium company would be anywhere in the range maybe from 500 million up to 2 billion in market cap. That'd be kind of my personal opinion. And then I would class a small company as anything that's kind of less than 500 million in market cap. Would you agree, or would you put maybe different numbers on these three?
No, I would agree with that. I think there maybe is another category beyond large now, just because there's so many companies that are, like you said, they're huge, 500 billion, 600 billion, $1 trillion. The fascinating thing to me is that these companies can be valued at $1 trillion, and it's not unjustifiable in many cases. I mean, many of these companies are producing 200, 300 billion dollars in revenue, which is just bonkers. Crazy. It's really, the internet has opened up this world where there's kind of this globalization effect where businesses can really get a lot of customers globally really easily. And it's opened up the door for companies to be that big. But yeah, I think we can go with those sort of classifications, and we can kind of muddle with it as we're talking through some of the different things today, so that we're kind of making sense. People understand what we're talking about. But what was sort of what's the first difference that you kind of identify that's different between these small, medium, and large companies?
Yeah, I think that the first thing that investors would start talking about when it comes to comparing large companies or small companies is growth potential. So typically I would say that large companies or very large companies, well, typically the opinion is that they have quite limited growth potential. The reason for that is that they've already done their growing. Like the very large companies of the world, for instance, Facebook, I think reaches over a quarter of the Earth's population each month. So that's like they're reaching a lot of people. So you got to question, well, how much further can they actually grow that number, say, of monthly active users? So typically what you tend to hear people talking about is that these very large companies, they've kind of already done their growing. They've come into the industry with something maybe game-changing or revolutionary that's really caught on, and now they've taken their share of the market, and they kind of just sit in their industry with their particular market share. And then on the flip side, you've got this thinking that, well, small companies, the up-and-comers, they've got all the growing left to do, right? So if you say maybe someone started a new social media company, just running with the same kind of example, and they only had, say, 10,000 users, well, obviously the potential to reach, there's so much more potential to reach so many more people. So they've got a lot of growing ahead of them potentially. So I guess that when you're looking to invest, it's in the small companies that have these massive growth opportunities still ahead of them. That's where you can sometimes find like the multi-baggers, the ones where you get in early, you see a trend, and then in the long run, if that company does really catch on, that's where you can see it, 100x itself, 1,000x itself if you kind of get in early enough.
Yeah, and that's certainly not to say that big companies can't grow, especially in this kind of internet age where, as I said, it's kind of quite easy for even really large companies to create a new product or create a new service that captures a huge audience. But yeah, in terms of percentage growth, it's going to be a lot harder for those bigger companies to continue to grow. And this kind of ties into when we're doing our individual stock analysis. The bigger the company that you're looking at, the more careful you have to be about what growth rate you're applying to that. Because something, say like a Google, maybe they've grown at 20% compounded, 20% per year compounded over the past 10 years. And that's maybe grown their revenue or their earnings 8 times over 10 years, which is substantial. But for them to now go ahead and do that again as a $500, $600 billion company would be very, very difficult. Not saying it's impossible. As I said, like big companies do it all the time. They impress us. They come out with a new product that is accessible to everyone. It solves a huge problem, but it's a lot more difficult than a company that is a lot smaller to just, double their customer base. If they, if a company has a customer base of 100,000 people, to double that to 200,000 people is nowhere near as hard as a Facebook going from having an audience of 2.7 billion people to then trying to double that and capture 75% of the global market, which would be insane.
Yeah. You briefly just touched on an important point there as well, is that these large companies can still impress us with growth, but usually growth happens in an S-curve. So growth is typically not linear. So at the start, it's very slow, and then it catches on, and then it goes through this rapid, like it really catches on and it starts skyrocketing, and then it skyrockets to the point where it just edges off and it starts to plateau. So it's important to remember that that growth rates generally, when you look at them over time, it happens in a bit of an S-curve. And what you touched on before is really interesting, is that these companies that do go through that S-curve and are starting to plateau, they still can surprise us with growth, but typically that growth comes from the company saying, okay, we're going to now do something different. So essentially, they create another product or something, or another service, or they change their business and focus on a different area. Because what they'll find is that, say, I don't know, if you're Apple, and you make the iPhone, and that's literally, let's just say that's the only thing you do, and then you make the iPhone and it goes through that S-curve of growth, and you go, oh, this is great. Oh, but hang on, it's starting to plateau out. Oh, okay, crap. And then it starts to plateau out. Then if you want to keep growing, then maybe it's easier if you go, okay, we've made an iPhone, let's make a laptop. And then they make the MacBook Pro or something like that, and then that's another product in their lineup, and then they can go through that S-curve of growth again, but with a different product, and they can keep doing that with other products to overall keep their entire business growing, even though potentially you might see one product plateau. So that's how sometimes you can see the big companies still impress with large levels of growth. But yeah, you're definitely right in what you say. For instance, for Apple Apple's nearly a $1 trillion company. For it to double, say, to a $2 trillion company, it's going to be very, very hard to do, like extremely hard to do. But if you look at good old, Brandon's Electronics down the road, which has just opened their first store, and, they're only worth maybe $1 million, it's going to be much easier for them to double into $2 million than for Apple to, say, double into $2 trillion. But yeah.
Yeah, definitely. And one other thing I just wanted to mention before we move on to the next thing is that size would also matter relative to the size of the industry in which they operate. Yeah. So you might be a medium-sized company, but if you're in a medium-sized industry, then there still might be a cap on how much you can grow. If you're already 50% market share in that, if the company's 50% market share in that industry, then it's going to be difficult for them to, continue to gain market share and to continue to expand their revenues. So if the industry is kind of like a cap. But if you're a small restaurant company, the restaurant industry is $2.5 trillion globally. Wow. So there's lots of room to grow. Yeah, it's massive. I just looked up that stat the other day, so I thought I'd chuck it in there.
Fresh in your head.
No, but yeah, it's it kind of depends relative to the industry as well. It is just kind of what I'm saying. Yeah. But the second kind of point we wanted to talk about as a difference between the sizes of different companies is what happens with institutional investors. Yeah. So the big fund managers. Yeah. What are they? What does it matter? What size businesses?
Basically, what you will find is that very small companies get completely left alone by institutional investors. Remember, institutional investors are the people that manage literally like billions and billions of dollars. Typically, they're the people that are investing other people's money. And a lot of these funds, these active funds, these institutional funds, some of them literally have rules saying that you cannot go and start messing around in some of these companies that are below a certain market cap. So, for instance, I don't actually know much about like what actual numbers they say, but say an institutional fund says, no, you can't mess around in companies that are under $1 billion market cap. Well, if you're finding a company that has, say, that has a market cap of $500 million, then it's going to be completely left alone by institutional investors. So this all comes back down to the idea of finding the businesses early on, and this is, I guess, a concept that's touched on in One Up on Wall Street. Who writes that book? I forget. Peter Lynch, I think.
Peter Lynch, yeah.
Peter Lynch, that's right. He's talking about how you have an advantage of being out of that financial system, that institutional money system, is that you can find great smaller businesses because you don't have a huge amount of money. You can find those great smaller companies and you can get in before they grow big enough for the institutional investors to even bat an eyelid, to even consider having a look at this company. And again, that's where you can get those multi-baggers, right? So if you're in a company where if you invest in a very small company that's been showing great growth in terms of, say, percentages, but they're still so early on in their journey that they haven't reached a very large size yet. If you get in early and you see this is a great company, it's got a moat, it's got a great management team, and it is growing very well, if you can find those companies, you can get in before the institutional investors, and it can eventually grow to a point where it does start attracting the institutional investors. And if the institutional investors all start paying attention and they see that, again, this company, wow, it does have a great moat, it's got a good management team, and boy, the growth is looking really good, then what you typically find is the institutional investors love to find good growth opportunities. So in these instances, sometimes they can start to funnel a lot of money into these businesses that are offering a lot of growth, so much so that you can actually be invested in a company and see the shares absolutely skyrocket if a lot of institutional investors, institutional money is getting behind this company. And that's where you can actually see these up-and-coming companies skyrocket to ridiculous valuations because they've just had so much money all of a sudden very rapidly thrown at them that for where they are right now, all that money being thrown at them pushes them up to a crazy valuation. But if you're in as an investor before that, then that's pretty good for you because it means you've made a great return on your original investment.
Yeah, definitely. And in some of the smaller cap businesses, even medium cap businesses, you can sometimes find stocks, like you say, that the institutional investors just even can't touch. So even if there's value there, even if they're undervalued and there's a good opportunity, the big institutional investors who control pretty much all of the money in the market, most of the money in the market, they can't really go near it because it's not going to benefit them to own that. It's only going to add a little bit, or
it's insignificant.
Exactly. And say, for example, in the case of someone like Warren Buffett, for example, where the investing style, similar to ours, is that we want to hold a small number of businesses that take up most of our portfolio, a small basket of businesses that we put quite a lot of money in. When you get to someone like Warren Buffett's size, it makes no sense to touch anything that's smaller than maybe $50 billion.
Yeah.
Because he only wants to have a small number of positions in his portfolio. And if he adds something that's $1 billion in size, then, okay, maybe it doubles to $2 billion, but that's going to be marginal to what his whole portfolio is going to produce. So yeah. You can sometimes find those opportunities where there's something that's a little bit undervalued that maybe the institutional investors aren't able to capitalize on yet.
Yeah, exactly right. Berkshire Hathaway, they've got, I think, about $120 billion of cash ready at their disposal to throw at something. So you can imagine if you've got a company that's literally their whole company, their market cap is 500 million, then Warren Buffett's going to sit there and look at this company and go, oh yeah, good company. But for us, it's just not worthwhile. It's just not worthwhile because if they do that to a lot of different businesses, then all of a sudden they've got a stock portfolio of 50 companies that are all worth 500 million. Then it's just too much for them to keep track of, and overall they just they want to find a few businesses that are in their scale. They need to be in their scale, which is in the billions and billions and billions of dollars to get that same kind of return for their investments. But yeah, the next thing, so that kind of wraps up thinking about small companies, big companies, and how the institutional money flows within them. The other thing we've got to talk about is risk. So there's no doubt that typically investing in, just generally, as a general rule, investing in small companies is riskier than investing in large companies. And the reason for that is, of course, large companies, they have a lot of money because they are large companies. So, and usually their business has been longer, it's been around long enough that their methods that they utilize in their business, they're tried, they're tested, their cash flows are strong, and they're reliable. So for these companies, it takes a massive stimulus to send that company bankrupt. But on the other hand, if you find a small company that's, trying to do something new, of course, they're going to encounter problems. Like every company will encounter problems. That's just a given. But as you can imagine with very small companies, occasionally they'll find a problem that's big enough that it will send that particular company bankrupt. It'll be too big of an obstacle for that small company to be able to overcome. So the way I maybe think about it is like, if you had to drive through a brick wall, would you rather be on a motorbike or would you rather be in a tank? Like, you'd obviously much rather be in a tank if you had to get through a brick wall. You probably don't want to take on the brick wall on a motorbike. So it's kind of like the large companies, there is less risk in that aspect because it's going to take a really, really big bump. In some instances, there might not be a bump big enough to send that company completely bankrupt. Whereas for a small company that's just starting up, they're pushing something new, they're on the cutting edge. In that case, then sometimes they will encounter what might just be a very small bump for a big company, but for a small company, that bump's big enough to send them completely bankrupt.
Yeah, and also adding on to that, a lot of smaller companies are much more likely to take on large amounts of debt to fund their operations.
Yep.
It's just natural that if a company is trying to grow, they're not profitable yet, they need to make a lot of investments, they need to gather a big customer base before they can become profitable. They're more likely going to be taking on a lot of debt, issuing shares that dilute the shares to the shareholders and make your individual share worth less. And that just increases the risk if something comes along like a recession and people stop spending money, and these businesses, their revenues go down and their cash flows go down, then yeah, those smaller companies are at much more risk. But then every now and then you get those big companies, and not even every now and then, it happens quite a lot, that you get large companies that they get to the point in their life cycle, kind of like that S-curve where they're plateauing. Yep. And the only way that they know to generate more cash for shareholders is to take on debt and buy back stock or do reckless things that end up actually destroying the company. So yeah, it's a risk. There's certainly more risk in smaller, unprofitable companies, but you got to watch out for those large companies that where management just comes in and wants to gut the company to make a little bit of money.
Yeah,
it happens.
True. It does happen. Yeah, it's happened in the past, that's for sure. But yeah, that's kind of another thing we wanted to discuss, small companies versus large companies. It's always worth looking at the risks. The next thing I wanted to talk about, and this is quite a common one between a small company and a large company, is that there's going to be a big discrepancy in the amount of financial data that you can find. And not saying that, small companies don't have to report the same as what large companies do. They obviously have to follow the same accounting rules. But because large companies are large companies, usually it's taken them a long period of time to grow to a large company. So in a lot of instances of the ultra large companies, you can have a look back at how their growth rates have been over 10, 15, 20 years because they've been around for that long, because it's taken them that long to get to the size that they are. Whereas for a company that's very small, you might only have, maybe it's only been around for 2 or 3 years. Maybe it's only been public for a couple of years. So you may not have reliable data on how they've grown over a long period of time. And that obviously just introduces more risk into looking into those smaller companies, because as a long-term shareholder, like you will feel much better if you can see that the growth of the company has been slow and steady and reliable over a long period of time. It'll make you feel much better than if you've got decent growth and it's been held up over only, 2 years? Oh, damn. I'd much rather see it over 10 years.
Yeah, definitely. And having a strong history of financial data is something that we both advocate for when looking at investments. It's super important to invest in businesses that have that track record, especially if you're going to be investing a substantial amount, because you want to know that they have that consistency of cash flow and that it's likely that they're going to be able to continue that in the future. And you're much more likely going to find that in large companies. And then the next kind of difference that we've kind of identified between different sizes of companies is stability. So Larger companies, they've generally been around for longer. As we just mentioned, they have that long history of financial data. They've been producing cash flows for a while. They've probably been through a few recessions and survived. And all of that means that they have a lot more stability.
Yeah. Yeah, and overall, this is just kind of a summary point that kind of encapsulates everything that I suppose we've discussed so far. We've talked about having large companies having a lot larger history of financial data. They've got much more money, so they can ride out the bumps. It takes a much bigger stimulus. All of that sort of stuff just being around for a long period of time. Typically large companies, as we were saying before, they've been doing their business for long enough that they know that the way they conduct their business is strong, it's stable, it's reliable, and typically that just gives larger companies much more stability than, say, a small business, which hasn't been around for a very long time. They're still kind of figuring out the structure of their business, how they're going to generate their money and that sort of stuff. But I just wanted to chuck this one in because on the flip side, small companies do have an advantage in the fact that they're not so stable, is that they've then got more flexibility. So if they need to reasonably quickly change their business to go down a different avenue that might be more profitable or, might be better to focus on in the long run, then if you're a small company, then that's going to be much easier than, say, if Apple wanted to completely revamp their business and change it and follow it down a different pathway. That'd be pretty silly because Apple's kind of got it figured out. But if they wanted to do that, if Apple decided it didn't want to make electronics anymore, it wanted to be the next McDonald's, then that it's a stupid example, but you kind of get it. It would be extremely hard for them to wrap up what they currently do and try and focus on this different avenue of building restaurant chains or whatever. Crazy example, silly example, I know, but if for example, you're a small company and you thought that you had this great business idea and you start following it down the path, but really the market's pulling you in a different direction, it's going to be much easier to just go, okay, let's reevaluate, let's change our business and go down this other pathway.
Yeah, no, that's actually a really good point. If you're a new company, a smaller company, you're a lot more adaptable to change in business. And there's always change in industries, in businesses. And sometimes the larger companies are stubborn. They don't want to change, or they just can't, and they can't, because when it comes to change in large companies, there's going to be a short period where they're going to suffer smaller cash flows, smaller profits in order to make that change. And often managers aren't willing to do that because they know that the stock price is probably going to suffer, and therefore their salary and their remuneration is going to suffer as well. Yeah. And a lot of managers aren't willing to do that.
Classic example here is what we're seeing with the traditional automakers. They've been making their internal combustion engine cars for decades and decades, and all of a sudden we realize that the future of transportation is running any transportation we have off of electric motors. And they've been doing what they do for so long, they're going to have to completely retool their factories. They're going to have to go back to the drawing board. They're going to have to completely redesign, their cars and their business, really. They're going to have to take on, or they're going to have to use a lot of their capital to reinvest, to change the factories around to start building electric cars, because obviously an internal combustion engine car and an electric car are remarkably different. They look the same or they can look the same on the outside, but inside they're completely different machines. So that's a classic example. A lot of the current car manufacturers are actually resisting. They'd much rather, do something like make propaganda or something to try and keep everyone buying the internal combustion engine cars, as opposed to take that massive step of having to spend so much money and retool all their factories and actually go through that process of changing their business. For some of them, they're so big that it's just, they look at the problem, they go, nah, this is too hard. Let's just try and keep going the way we've always done it.
Yeah, no, that's a really excellent point. It's a really good example, actually. A little bit better than your other example.
Yeah,
I'd have to say.
Yeah. Yeah, but like, if next week, all right, how much money will you give me if next week Apple comes out and says we're entering the restaurant industry? I'd get pretty good odds on that.
I'll buy you a Tesla.
Yeah, all right. You heard it here first. You better not cut that from the podcast.
I cut it later.
Yeah, cut it later. Yeah, damn it. What? He's taking down the video. Yeah, but that's kind of stability. The last thing that I just wanted to very quickly chuck in here is kind of the situation when it comes to dividends. So usually large companies, when they get to the large kind of size, they go through that S bend of growth, and typically that S curve, they hit that plateau, and all of a sudden they used to be able to take that money that they're making, pump it back into their business, and they used to get great growth out of the business. All of a sudden, that's not exactly what they're getting anymore. They might try pumping more money in there, but they're not achieving that same level of growth. So typically what you find in that situation is the company goes, you know what, fair enough, we're now seeing the plateau in our growth. Instead of trying to aimlessly pump all that profit back into our business to try and make it bigger and better, that's been proven that it's not working too well. Let's just give it out to our shareholders as a dividend. So typically what you'll find is that large companies are dividend paying companies. So if you are like a dividend investor, typically you would be investing in companies that are very large. Whereas a small company that's on the other end of that S curve, that's at the very start, it's unlikely that they're going to pay a dividend, because they need to keep as much of that money as possible so that they can then pump it back into their own business to try and get themselves up that S curve of growth.
Definitely. Yeah. If you're someone who wants to build a dividend portfolio to maybe make some passive income, maybe you're at that stage in your life where capital appreciation isn't the primary goal of your portfolio, the primary goal is to generate some passive income, then yeah, you're definitely wanting to look at those larger companies, because it's much more likely that you'll find consistent dividend payers, companies that have paid dividends for 10, 20 years consecutively. You're much more likely to find that in larger companies. Smaller companies, generally, as you said, they've got too many growth opportunities that they can't afford to pay out a dividend. It's a much better investment for their business to keep it within the business rather than pay it back out to the shareholders.
Yep, I agree. All right, cool. That wraps up section 2, guys. This podcast is going to be a little bit shorter today just because we're both pretty stressed on time, but we've got some pretty cool stuff coming up in the next couple of weeks for the podcast, so we'll have to stay tuned for that. But we'll just do a couple of questions of Q&A and then we'll get out of here. So a little bit of a shorter podcast for today, but we've got some exciting stuff coming up in the next few weeks. So the first question we've got is from this person is interested to hear if either of us have actually bought any shares this year at all, because of course we're really struggling to find great investment opportunities. So if so, what percentage of your net worth is invested in stocks at the moment? Did you want to talk about this one?
Yeah, that's a good question, actually.
Yeah.
Have I bought any shares this year? Yes, I have. I'm trying to think off the top of my head how much of a percentage that increased my portfolio. Not much, maybe less than 5%, probably less than 5%. Yeah. But in terms of opportunity, in terms of how much I'm invested in the market, probably about 50%, I'd say. Maybe a little bit more than 50%, something like that. Okay. But the reason why I have so much cash is just because we're not finding really good opportunities at the moment. Even that investment that I made earlier this year, it wasn't fantastic. I only put a little bit in because I like the company, and it's kind of more along the lines of Buffett saying a great business at a fair price. It's not at an amazing price. I'm not thrilled about the investment, but I think that it offers a decent return to the point where I had too much cash on the sideline. The cash was building up to 60, 70%. I needed to invest something. And that was like the best opportunity that I could see available for me. But that's generally kind of the approach that I take is if I can't find really great opportunities, my cash pile is going to build up, but then I always want to be significantly in the market, which means that if I have too much cash on the sidelines, then I'm willing to accept a lower return to have a little bit more money in the market. And when I say accept a lower return, I'm still being conservative. So it's likely that those businesses will end up producing a return that, is that 15+%.
Yeah. I'm basically the same as you. I haven't found... Well, I don't even think I've found any like margin of safety, like proper good margin of safety prices on any shares this year. It's just a really hard time to try and find those kind of companies. But I'm still always in part a passive investor and in part an active investor. So I'm definitely still contributing to my passive investing strategy, which is completely market tracking over time, averaging out to the long-term rate of return. So that always churns away in the background. But I think I'm actually a little bit more in cash than what you are. I'd probably be like about 60%, and I actually maybe, no, it probably would be about that. I really don't like that. Like, it's not like I'm trying to be. I really wish I wasn't, but yeah, I just don't want to invest in anything. Yeah, I want to try and make sure that I only invest at really good investing opportunities. But like what you say is definitely justified as well. You definitely want to find good companies, and if you can find good companies at fair prices, then that's fine as well. All right, should we do one more?
Yeah, let's do one more. I'll pose this one to you.
All right.
And this question is there an easy way to find out how many shares a company has in circulation?
Yes. Yep, so the amount of shares that a company has in circulation is just called the shares outstanding. It was a little bit confusing when I first started out because I had no idea that that's what that meant. But what you would typically find is you could log into like any like Yahoo Finance or anything like that, and Yahoo Finance will have data on the shares outstanding. So that's a pretty easy one actually. Yeah. You never have to calculate it yourself. It's always given to you as a number. But yeah, the shares outstanding is the total number of shares in the company. Yeah.
Yeah, and that's all we had time for this week. So thanks everyone for tuning in, and thanks everyone for leaving Q&A questions and topic requests and all of that stuff. If you have any topic requests for our middle section, we're always looking to talk about things that you guys are interested in hearing about, problems that you have in the stock market and finance in general. So make sure you go ahead and go over to youtube.com/Hamish Hodder, click on the video version of the podcast, and make sure you leave a nice comment there. Leave a topic, leave a question. I forgot what I was going to say for a second there.
Yeah.
But yeah, thanks everyone for tuning in. Thanks Brandon for joining us as always.
No worries.
And yeah, we've got some exciting things coming up in the next few weeks. Hint, hint. So stay tuned. See you later, guys.
All right. Love you. Bye.